And he made a very clear distinction between market efficiency and inefficiencies, and he ruled out all potential market inefficiencies. And even in his anecdote, as I told you before, that he said, particularly in housing, you never ever should observe any type of bubble, because people are smart people and rational people do not allow for big bubbles. For instance, you don't buy. If you're a rational and smart individual, you never buy when the prices are beyond their fundamentals, beyond their, let's say, mathematical rule or rational rule. Okay. At the same time, in a bubble environment, you can buy and sell things when the prices cannot be justified with techniques, with fundamentals. But once you have a bubble, since you don't have a bubble, the economy should never ever be interfered. But once you have a bubble, this should be interfered, right? It could be interfered because there's a bubble, and you want to make it smaller before it gets burst. Okay, so that is, let's say, the distinction, especially that has a lot of political economy, how to say, interpretation as well. Okay, so from here, Schiller challenged that. Professor Andrew Lowe, from a very technical way, challenged that. Let us discuss the Nobel winning article series of Professor Schiller a bit, and then we try to complete this test. But before, as I said, there are two Nobel Prizes goes with market efficiency, and two sets of Nobel Prizes would go with them. The first one was to do with Professor Schiller, Fama, and Hansen, and the second following one is 1917 by Professor Taylor. Professor Taylor is basically I would say, the inventor of behavioral finance, where Schiller also was the founder of that idea, but his research was both in finance and economics, but Taylor was more to do psychology, and he made a bit of more investigation on that. Surprisingly, he's also from Chicago School, but I mean, he has his view is, of course, not very close to what typical Chicago people thinks about that. And nowadays, of course, the economics is in a way still in a conflict, even though, as before, neoclassical foundation is not as strong as before, but things do not change immediately. Behavioral finance is improving a bit, but not to an extent that it is okay, but not to an extent to reproduce the conventional finance or conventional economics. I mean, the discussion still goes on, but they are hot. I mean, they are hot. People are working on it. And experimental economics and questions are relying on non-rationality or bounded rationality, or these type of issues are very hot in economics research. As I said, it's not yet there, or it's not, maybe it won't, it's hard, it remains to see, to be seen. It might be taking time to replace that, but still that is really only a lot of discussion. In the past, that discussion was very clear, but now that is again under question. Anyway, so going back to Professor Taylor's research. So Taylor says that he made a lot of research and combined the research made in psychology into finance. And his main findings were the following, saying that there is this overreaction hypothesis. What is overreaction? He says that people are overreacting to the news. Sometimes they overbuy stocks because of the good news. They overreact to that. For instance, if the economy does good, or the technological stocks are doing good, but they sometimes some kind of exaggerate that type of news. At the same time, they overreact for the bad news. They sell. Once they sell, they keep selling it, even something which is fundamentally valuable. But since the market sentiment is against panic, then you tend to sell a lot. So that is the idea for panic versus overconfidence. So there, in one end, you have this one, and you have another on the other hand. So that makes people to overreact, and that is where Professor Taylor and De Bond, who was one of his PhD student, I believe, at Chicago or somewhere. So they were together for that research. and that is overreaction hypothesis in 1985. And then the idea goes back here that what they do, they buy stocks when they are oversold. So what they do in a way, mathematically, very simple stuff. So what they do, they sort all these stocks who are, let's say, for their relatively, their values in a way, they look at the worst possible top or worst, top first 10% or 25%, and the top 25%. And then what they do, they buy these, of course, with an algorithm and everything, they buy the worst oversold stocks, and they sell the overbought stocks, and then they keep doing that, and they show that they can make profit because there is a mean reversion. Okay, things are go badly, but then there's a mean, it goes up and then it goes down. That's exactly why, for instance, the Turkish stocks are making a bit of marketability recently, because many people think that, okay, things are bad, things will be bad for a year or so, maybe 2 years, but at the end of 2 years, the stock values are oversold. I mean, now, like in dollar terms, as many of you would see, around 70% to 50% lesser than that of their peers in emerging markets or historical. So that is a typical overreaction hypothesis. If you really choose the right stock now, and if you have time to wait for another year or two, then that definitely they will be good for money. But that is, again, overreaction stock, but not too many people are doing that. Okay, so that is, of course, an idea which is to do with, which is in conflict with rational expectations idea of market efficiency. Why is that so? Because if individuals are so rational and smart, why would they allow some stocks to be oversold and some stocks to be overbought? Because if all the people are rational enough, then on average, there won't be any type of overbought and oversold stocks. There's a big discussion about that. But from my point of view, I'm more like inclining to more Shiller and Taylor type of stuff, because market efficiency would work in some markets, but not in all markets. I would easily can see that there are certain times market efficiency work for certain markets, but not all markets. Not all times, for not all individuals, because individuals, so that is an area that which we like as well. Psychology of individuals and psychology of investors are really different. We made a lot of study on that, and you really find some weird, some unexpected results out of each of their decision, because people have different biases, psychological biases, or they move together. There's a social psychology effect playing around. Not only that, but also like TVs, advertisements, they really work a lot. Politicians also involved with that. Nobody really wants stock market to go down that badly. If there's a bubble, I mean, if they see the bubble is around, the central bankers or whoever are not going to keep it, are not going to immediately react to that and kill it. They can do all sorts of things for that. Just wait for a second, I'll be back in a minute. So in that regard, we have this type of things happening in the background. And what is an interesting paper, interesting. So that is the Nobel winning actually article. I mean, there are a series of articles, but this one was a very interesting article, a 1985 article, and there's many more. And John Taylor was very smart, and he was working with some psychological people around, psychology professors around, and he read a lot of psychology, and then he combined things together. I mean, for this Nobel stuff, I mean, you have to make a big contribution, and he did. So it doesn't have to be excessively mathematical or technical. It depends, let's say, the genuine idea. So these are very clear guys, and they're clever guys. I mean, they have good intuition as well. Same another person, which is really an admirable professor, I would say, Professor Schiller from Yale. He's a very, very good one. So he has been the only one, I would say, who said there will be a bubble. There's a bubble in 1987, and there was a big crash. And before he was publishing papers saying that there's a bubble, and then he again made a call in year 2000 about Nasdaq, the tech bubble, and that also went terribly down. And then even in 2008 global crash, he was there, and he went Fed, and there was Bernanke was chairing, and in year 2004 he said that there's a clear bubble in the housing market, and then Bernanke and all those guys were kind of reluctant to believe that, even though Bernanke is also a good economist. And then he said that, okay, look at, they let some of the econometricians to analyze whether there's a bubble or not. And then all the econometricians, all these PhDs in Fed made a research. Of course, central bank's research also cannot be like an academic research in a way, because they have also a bias in a way, because Fed has a position. It's not easy to come up and publish a paper in Fed which is totally in conflict with the Fed's decision. Unfortunately, I have to say so. And yet they said that, okay, even though Professor Schiller says that, but that is not a big deal. It is not going to be a bubble. It's not really a bubble. And of course, as Professor Schiller forecast was correct, in year 2008, there was a big crash, maybe the worst possible crash before, of course, COVID-19, which is about the housing market. Why was it so easy? What was the advantage of Schiller to give a call such that, like that? Because he was also collecting housing data for US. So now his index and his housing index is now Case-Shiller index. There was a professor named Case and Schiller. So then they sold that company, or whatever the idea, to Case-Shiller index to S&P. So that is the reason why he was a hands-on economist. As always, if you do this type of research, unless you do an excessively big theoretical issues, you have to have a hands-on. At least that is what I believe. The ones that I really follow and I really enjoy reading, and I really get a lot of intuition and insight, are these type of professors. They have a hands-on thing. They are following the markets in a reality. They have a big testing, let's say, environment for reality. This guy, and as I said, Andrew Lowe, and some of these guys are really good ones. They're also, a part of them are one way or another in the field. They get a lot of information in the field, which is good. If you can't just close your door and do research. You can do the theoretical research, but once you touch data, I think you have to, you should have a kind of an interaction with others, and that is Schiller as well as Taylor, the same guy. He was also involved with any type of fund management issue. Schiller does not do that type of stuff, but he was all around, and he was also doing this Schiller stuff like that. And there was another guy, was a very, very good guy, Polomarkakis from Yale. He was also a person who pinpointed that there will be a crisis coming, because he was also running a hedge fund by himself. He is very highly mathematical. He is one of the best mathematical economists, but at the same time, he knows how these markets work as well. In any case, so the idea goes back to, in the Schiller's case, so he says that stock price follows such a future expected dividend, as we discussed in a very fundamental way. So gamma is basically discount factor of the interest rate in a way. Expected T is equal to what? Expected T is equal to the future state, and what is CT plus 1? That is what we can easily say that we can easily say that is, let's say, the one which works with the future state of the dividends will be determining the prices. Okay, so it means that he puts a boundary for that. He says that, okay, for a rational individual, if that is the way it works in terms of the price determination, it has two components: the interest rates and the future dividends. So which means that if dividends are the major source that is going to show you this type of a framework, then what is important is that who is going to determine, or who's going to determine the prices of typical future prices of a stock price. So it means that price is a function of the future states of dividends. Okay, so there should be a boundary for that. So it means that the volatility or movement of prices and the movement on dividends should one way or another should have a bound. Okay, so normally if you think, let's say the causation goes from so the prices basically determine, or the dividends determine the prices. So the value, or let's say the movement on dividends is going to have a kind of a boundary. So normally stock prices should be going up and down, and normally, so if that is dividend, if that is, let's say, if that is dividend, if that is prices, but if the dividends are sent to be, or if the prices are moving wildly, much more wildly than that of the dividend, he was saying that, okay, that might not be really, that might not be really a case which can be explained easily in this context, because he says that how can we create such a thing in this environment, because he says easily, you can say that normally as the movement of dividend and the movement of, let's say, stock prices should have a kind of a logic. You cannot really have everything to be moving around like that. So there should be a boundary. And then in his research, he collected all the past dividend data, and he wanted to compare that with that of recent data. So what Schiller collected a very long data set of real dividends for the US and the prices. And then he made a very nice research, and in that research, so that is really what his major finding. So that is again a Nobel winning articles, one of the Nobel winning article that is from that article. So the one which he says that if the prices are really determined by fundamentals, then P star, okay, is the price mechanism of price formulation, which goes with typically with the case of with the case of theoretical prices. Okay. However, the other P is the actual prices. As you see that the one with the dashed black one and the other one are moving in a direction, but the volatility or the margin at which P star and P are moving cannot be really justifiable. In other words, if P hat is really P star is really the major source of movement, then P is not working accordingly. It's moving way more complex and way more volatile than that. And then you can now read from his article to see how he has really refuted the, at least empirically, about the important issues in the field. So he says that we have seen that measures of stock price volatility over the past century appear to be far too high, 5 to 13 times too high, to be attributed to new information about future real dividends, if uncertainty about future dividends is measured by the sample standard deviation of real dividends around their long-term exponential growth path. Okay, so what does that mean? And then another one, let me finish and then I'll take your comments on it. The other, again, quotation from Professor Schiller in 1981, 40 years of is one of the most influential paper. As I said, maybe that is a Nobel winning, one of the crucial seminal papers of him who made him to get the Nobel Prize. So what it does in this context, he says that the lower bound of a 95% one-sided confidence interval for the standard deviation of annual changes in real stock prices is over 5 times higher than the upper bound allowed by our measure of observed variability of real dividends. The failure of efficient markets model is thus so dramatic that it would seem impossible to attribute the failure to such things as data errors, price index problems, or changing in tax laws, which is exactly by that time has been supported by pharma. Okay, so I'll put my last sentence, and then I'll try to see your own wording in here. So what he says that if really everything is being made by or changed by typically actual dividends or the changes in the long-term trend in dividends cannot be justifiable with the stock market prices. He says that 5 to 13 times higher than that of dividend volatility. So if people are really buying and selling things just on the basis of fundamentals, so why should the stock prices should be moving up and down for 13 times higher than that? So what it looks for that, and he says that that cannot be expressed by only data errors, price errors, or changing tax laws, which is possibly was the side lines to be, defending this market efficiency by pharma type of arguments. So he refutes those arguments as well. He says that that's not justifiable by just data errors, price index problems, or whatever. There's more than that. It's a more fundamental issue. And then what is more interestingly, he claims that such of this type of inconsistency can be more justifiable with Feds, with more bubble creating social psychology, more like advertisement, more like letting people on the street and whoever to be involving or to be getting into the motivation to overbuy and oversell things, because things are made accordingly. They make profit out of that, and they are creating a lot of money by buying and selling these type of stuff. Okay, so that is a very important contribution of Schiller, who caused him to get the Nobel Prize. People's excessive trading because of overconfidence, they tend to make a lot of losses. Okay, why? Because people tend to buy and sell a lot, but that is more of frequent, because whenever they make a profit or they say, "Oh, that's great," so he believes himself or she a lot, and then they make this type of profit and they continue like that, and that makes them a very interesting and very bad result for people, because particularly male and relatively younger people tend to make a lot of mistake in terms of their investment decision, because they buy and sell very often. And I would not only blame them on the, let's say, people's own attitude, but also the environment makes them like that. I mean, all these media and wherever. And very interestingly, there is another thing which is very important. For instance, people have their own biases, in the sense that they all have some type of interpreters or yorumcu in a way. So they watch any person who is like more like a bearish one, look for more bearish commentator or news, or chooses the news in a way, the bad news, and the other ones look for the good side. Okay, so that makes things a bit of conflicting as well. So that is to do with, in a way, psychology, but at the same time, the mass media in general, even social media in a way, they tend to get a lot of advertisement. So they should find a way in which that advertisement goes for public's interest in a way, which is not an easy task, but your friends suggest some type of bona fide stuff, like people doing these things for fun or for social responsibility and everything. It could be a good way to start, but there's a long way to go. And unfortunately, my belief is that bureaucracy or regulators can't also solve this problem, because they are, in a way, first of all, they are also a part of it. They want to solve things, but they don't want to be very radical. They want to keep business going on, because in a way that liquidity, that profitability in the financial sector also, in a way they also make some, not money, but their position or their let's say their well-being in a way is related to the profit generating of the whole market financial system. It's really difficult to solve these issues altogether because bureaucrats are there, but they are also under the, let's say, politicians. So, I mean, there's a lot of conflict of interest. I mean, there's politicians, businessmen, market participants, and individuals and investors and media groups. So, I mean, that is not an easy task, and capitalism is not as easy as you look from outside. And the solutions that you suggested are not all that easy to come up, especially if you look at this type of area. The nice and maybe promising things are recently good suggestions is about independent advisories. Independent advisories are, if we still don't have that, Turkish Capital Markets Board will allow some commentator or some guidance or some type of new investment consultants, but they'll be independent. Independent meaning what? They will be still be liable to SPK, Sermaye Piyasası Kurulu, but at the same time, they are not going to be they're not going to be organically linked to a known company, so they can be totally independent. Then their success will depend maybe on their own performance or calls. On the basis of the calls, then they might really make some type of revenue. So that might be promising improvement in all that. Because otherwise, I mean, such a volatility and buying and selling and the transaction and making money out of buying and selling decision or people's greed and panic kind of thing cannot easily be solved. And people are, in a way, some people are also happy with that. They're inside the whole thing and they like buying and selling. They have the overconfidence issue. But there are some guys are out there and they don't really want to. They want to keep their savings intact, or at least they want to improve it in a proper way. And they have been somehow there needs to have a more inclusiveness here. But that is again very top and big story. But going back to our market efficiency story, I mean, if you ask me that, I mean, the winner of them, especially after so many crises, should be more related to more Keynesian type Schiller versus Taylor. I mean, to me, that seems to be a better explanation of that. I mean, but at the same time, I mean, fully refuting market efficiency could also be a wrong way to do. For instance, in euro-dollar parity kind of, with an exchange rate, I mean, it's a very deep financial markets with too many players, and it's not easy to change things accordingly. There might, for instance, if you want to see any type of market efficiency context, that might look slightly better in the some of these FX markets, such as not dollar TL, but euro dollar, for instance, could be a better way. The market works better because there's so many buyers and sellers, and there's a huge liquidity in both of the markets. So that might be one way to discuss that. And the final thing is that Andrew Lowe, the well-known MIT guy, has his new theory. It says that adaptive markets. It says that, okay, you cannot totally refute market efficiency. However, the markets are adaptive and they adapt things and stuff like that. So that is he has a recent theory, which is in a way is proposed, but again, is not strong as market efficiency. Maybe I should stop that for this thing, and then let me introduce at least an introduction to derivative markets, and then continue them in the next in Tuesday. Okay, unless you have any question, I'm stopping here to switch to another topic. Var mı soru?